Today's episode is brought to you by Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 211. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes and Spotify. It really helps provide feedback for me and spread the MicroCap message. First, before we get into the rest of the intro today, thank you so much for all the kind words and congratulations. My wife and I are so excited to welcome our second child into the world. He was born on January 18, 2022. His name is Jude Zachary Kraft, and we're just beyond stoked. He's amazing. And so, again, that's also why I had to apologize for this episode coming out. Maybe it's probably about a day late. So, again, I appreciate you all listening and the kind words and everything like that. So thank you. Special thank you to our sponsors for today's episode, Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's www.streamrg.com using the promo code MicroCap. And Quarter, whose mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's Quarter, Quartr. We are also excited to host our first in-person event in nearly 3 years. The Planet MicroCap Showcase is back in Las Vegas on May 3rd through the 5th, 2022 at Bally's Hotel and Casino. It's time to see each other. It's time to network in person. Let's make it all happen in the entertainment and business capital of the world. For more information, please go to www.planetmicrocapshowcase.com. See you in Vegas. Now, for this episode of the Planet MicroCap Podcast, I spoke with Joe Magyer. He's the co-founder of Lakehouse Capital. I remember seeing Joe's presentation, I think a year or two ago at the MicroCapClub Leadership Summit, and I've been a follower ever since. In this conversation, Joe and I discussed his experience launching the Motley Fool in Australia, Lakehouse Capital's investment approach, research process, and so much more. Thank you again for tuning into episode 211 of the Planet MicroCap Podcast, and please enjoy my conversation with Joe Magyer. This episode is brought to you by Stream by Mosaic. You can find them at www.streamrg.com. That's STREAMRG.com. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream was built by Mosaic, and unlike any other transcript libraries, Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.com. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and you can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is a gentleman who I actually saw do a keynote presentation at the MicroCap Leadership Summit. I think it was a couple of years ago now. And I'm just really stoked that he's got a little time on his hands right now that he can talk to Bobby Boy. So I love it. We got Joe Magyer here, co-founder of Lakehouse Capital, soon to be a hop, skip, and a jump, my neighbor here. So, Joe, what's going on, man? How you doing?
I'm great. Thanks for having me. Look forward to chatting.
Absolutely. So I got to start there. I mean, you announced on Twitter, and I think it was in October, that you're currently based in Sydney right now, and you're now making the move back to the U.S. to Austin. I guess it's been 9 years, right? Since you've been back.
9 years down under.
You haven't developed your Australian accent. I'm sure it comes out when you're at the bar, of course, like that, like most of us.
Well, I picked up a lot of Australian words, but yeah, the accent, I still have a hard American accent. My wife picked up an Australian accent, but I'm pretty committed to my neutral American accent.
Is your nickname, you know how they always do, like I'm a follower. I love surfing, so I follow pro surfing, but they call it like Joe Parkins is Parko and Dingo. I mean, are you Mago or what's
I get, because Joe is short for Joseph, I get Joey sometimes.
Okay.
But I don't really have like a super cool, like one of my favorites is a guy's named Dave. Their nickname is Davo. Like, that's a fun one. Yeah.
That'd be pretty funny. I mean, I don't know how tall you are because we're doing this virtually, but that'd be pretty funny. It's like you're 6'5" and they're calling you a Joey. You know, yeah. I very much would appreciate that. But tell us what brings you back stateside?
Sure. Well, originally from Atlanta, born and raised. In a nutshell, born and raised from Georgia. Moved to the DC area for a few years, which I loved, and then had an opportunity to move down under to help grow the Motley Fool's Australian research business. So I'd been with the Fool at that point for 6-8 years, loved it. Working at the Fool's like working in investing fantasy camp. It's really great. And the idea or the opportunity to go abroad and get international experience was really attractive to me personally, professionally. So growing up, I never had plans to leave my hometown. I loved it. But as I got older, I came to widen the lens, and my wife and I just got married, and we thought, man, getting to live in Australia for a couple of years with no career risk essentially, and helping to grow like a startup part of the business, let's just go for it. 2 years turns into 9, and I guess we got here and just love the place. If anyone's visited Australia, you get great weather, food, people. Culture. There's so much to love about being here, and in Sydney in particular, it's a major financial center ringed with gorgeous beaches, which is attractive. After about 3-4 years, we launched Lakehouse Capital, which I co-founded with Donnie Buchanan, and that's gone really well. So that's been going for about 5 years. But as you may have heard, there was a virus that started spreading at some point. And Australia closed its borders hard. So basically, the border's been closed here it's now partially open, but almost 2 years. And a bit of a long story short, as much as I love Lakehouse, it's been an amazing experience. We've gone from 2 to 13 employees. The business has gone really well, really pleased with what we built. My wife and I just want to get closer to family at the end of the day. And at the moment right now, between shut borders and just distance, we were like, we just, for our sake, for our family's sake, for our kids' sake, we just want to be closer. So made the tough decision to move on.
I was going to ask, because it's been, obviously, I have a few colleagues that are based down there, and it's interesting. I think on Twitter, I don't know if it was yesterday or the day before, it was like #mass psychosis or something. Like what the heck's going on there? Have you guys even been able to leave the country, or I know you can travel between states a little bit, right?
Well, you can leave the country now, okay. But for better and worse, the country shut the border. It's one giant island essentially, plus Tasmania, to be fair. So any people from Tassie listening are offended, and shut the gates, and it kept COVID up. And for the longest time, we essentially had 0 COVID or close to it, which was great from a public health standpoint. But obviously, there are some costs to having a closed border, and they kept it closed for a really long time. Eventually, we achieved something like 95% double vaxxed in New South Wales, is where we're based. And yet Delta's not Delta, what are we on? Omicron's ripping through. Anyway, so yeah, that's its own rabbit hole. But yeah, borders have been closed, and we've loved living here. It's been great.
Yeah,
love it, Lakehouse team and all that. But we're just looking forward to get closer to it.
You're about to get a major COVID culture shock going to Austin for sure.
I'm sure.
That's gonna be a big day. My wife and I went to Austin to visit. We were looking at it actually briefly, and we visited probably like the worst time of the year. It was remember that ice storm that hit? I think it was earlier last year.
Yeah.
I love Austin. It's an amazing city. But yeah, like, one, we hit it at the worst time, but like we're beach people. So like we couldn't wrap our heads around like not being near a beach. Like it just, we couldn't, but enough about me. So let's dig into a little bit. This is, listen, we could talk about, moving across state lines in different countries all day. And I love that stuff. I find that fascinating as well, but you're on an investing podcast, so we probably should talk about that a little bit. So love to learn a little bit more about, your investing philosophy. I'm guessing you had a lot of influence from working at the Fool as well. So I'd love to hear more there.
Sure. Well, absolutely. At the core, I'm a long-term investor. And I guess I'd say I'll talk about a couple of things that I think people on FinTwit can take for granted sometimes, because FinTwit can be an echo chamber, which I don't know that people realize necessarily. And I can speak a little bit to this, but things that I realized once we started Lakehouse and really got inside the machinery of, investment management and seeing, you have your preconceived notions of what being a fund manager is and what the business looks like, all aspects of it, from, distribution to trading, to the research, to, client engagement, dealing with brokers. And then you get inside it and you see how some things are different. And I guess what I'd say is, when I came into the business of investment management, I thought that people in the business were really short-term oriented, but it turns out they're much more short-term oriented than I thought they were. And that's just something that permeates the business. And, if you look at studies, they'll show the median fund manager has a time horizon of only about 6 months. And I can tell you, when you get in meetings with other managers, so we go to broker lunches, for example, and you have a CEO, CFO from a company, they're presenting, be 10, 15 p.m. sitting around a table. Sometimes it feels like we're the only person not trying to triangulate, what the next half's EBITDA is going to look like, basically. And just operating on a different time horizon as an investor is such a powerful thing. And I'm not going to say that it's impossible to make money over the short term. However, the evidence shows on average, the vast majority of people try to do so. Jim Simons can do it, but no offense, but if you're watching this, you're probably not Jim Simons, and you're probably not going to have success day trading. So try to put time on our side and evidence. You look at virtually any study out there across markets, time horizons, they all show that investors who trade less on average have better performance than those who don't. I guess you asked philosophy. I think another key thing for me that I hold dear is that I'm a high conviction investor. Again, when you look at research and all the evidence, it shows on average, investors who invest with more conviction have better performance than those who don't, which makes perfect sense, right? Because when you're being pragmatic about it, you can only cover so many ideas at once and know them well. And even if you could cover them all, frankly, you don't have that many great ideas. I mean, I personally don't, and I don't mean that in a cynical, self-effacing way. It's just that if you're looking for, essentially what I'm looking for are situations where you have a big asymmetric skew. You've got multiple ways to win, few ways to lose. And they're hard to find. And if you're looking to find ideas like that you can own for many years and they can reinvest in attractive rates for many years, well, there aren't, 50, 100 of those at any given point in time that I want to put capital behind. So backing our best ideas has always been very intuitive to me, but it's evidence-based. And, the evidence on that is, it's really striking. And there's a range of different ways you can look at it. You can look at it fairly simply about, PMs with fewer holdings outperforming, but then you can look at some studies that show things like strategies where they move from single manager to dual manager, performance degrades on average in those situations. And what happens in those situations? They expand the number of holdings. And that's true from dual manager to multi. But the funny thing is it works in reverse too. So when you go from a multi-manager to dual or dual to single, the number of holdings changes, and lo and behold, performance changes too. So, for us, I think just backing your best ideas. And I will say, for the retail investors watching, there's a degree of pragmatism here, because I'm kind of talking about this in professional context where, high conviction is, 10 to 20. I think a lot of retail investors they would look at that and be like, oh, that's pretty diversified. And, and you look at the data, actually, that is pretty diversified. But I guess in the context of professional environment, if you look at our global fund, we own around 20 holdings historically, which is, for context, in the top decile of concentration in our peer group. But if you look at the median for the peer group, they own over 60. And that's the median, and they own something like 66 companies. So, again, it's just a reminder of FinTwit can be a bit of an echo chamber. And I don't mean that negatively. It's just when you follow a bunch of people who you're like-minded with, that's good and self-reinforcing, but you kind of lose sight of, your average professional is not running a 20 stock portfolio. They're running a 60 to 70 stock portfolio where they're managing career risk. They trade often. They don't want to own stocks that are hard to defend when they talk to clients. And all that is to your advantage if you're a retail investor who's patient and does the work, or investing in, smaller companies with a different time horizon.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter, and that's Quartr. Now back to the show. So we mentioned how the Fool strategy, it's almost like a never sell type strategy, long term, holding on to these businesses. You have that mentality even when you're going in and looking at them. I'm always curious then, for folks like you and others that have that long term mindset, what causes you to sell them?
Sure.
Do you ever?
I will say I sell more than David and Tom. David essentially never sells, so it'd be hard to sell to the same degree that he does. For us, I'd say that the biggest reasons are, one, if a thesis breaks, and I think the biggest mistakes, the two biggest mistakes that I've made in my career process-wise, not just like individual situations, but process failures that I've learned to improve upon over time. One was averaging down in situations where fundamentals weren't working. Fortunately, I've stopped stubbing my toe repeatedly in situations like that, but I've learned that the hard way. The other would be hanging on in situations where your thesis is just broken and continuing to justify it. And you wake up one day and the thesis that you're articulating to yourself and to clients is so vastly different from what you signed up for. Now, a tricky thing with that is, sometimes when it's most obvious that a thesis is broken is when the stock has already been hammered, right? And when you're cutting bait at that point, you kind of have to find this balance of, am I selling at the worst possible moment where I'm extremely consensus on being negative? But I guess I'd say to that, we try to be a little more pragmatic and pay attention to signals around just fundamentally, is the investment case we had here going the way we expected? And if it's not, then we need to be sharp about that and intellectually honest. And, we need to, a lot of time you're relying on what management says to give context and color around that. And do they have credibility with you? Do they have credibility with the market? That's where a lot of the qualitative stuff really comes in. But I'd say that would be the biggest thing. Is the thesis unmoored. The other would be on valuation. So we're growth investors. I didn't really talk about that, but we are growth investors. But at the same time, I'm not a glutton for punishment. I'm not a masochist. Like, I don't want to intentionally overpay for something. So we do our valuation work. We think about reasonable ranges of outcomes and expected returns. And, if we own something and it's gone really well, even if it's fundamentally shot the lights out, there are thresholds in terms of expected returns going forward and portfolio construction needs that I would say, well, look, we're going to need to resize this because this doesn't make sense. And so, last year, probably around a year ago, obviously it's been a tough environment for growth investors, but we exited 4 companies in the span of a few months, which for us is like, whoa, super active. But there was a window there where valuations for particularly SaaS names just got super high, and we don't like selling great companies, but there were some prices where we felt like, we just can't justify continuing to hold this. And when you're working with a large mandate, you can reallocate elsewhere. And so that's what we did. But those are typically the 2 biggest reasons.
Got it. And continuing down this line as well, when you're building your thesis, what kind of checks do you put in place where, like, obviously, okay, best of all possible outcomes here, expected returns, all that stuff, how much emphasis do you put on, okay, these are the 1, 2, 3, 4, 5 things that could potentially go wrong in this business? How often do you do that? Or do you do? I'm sure you do it for everyone.
Every time. Yeah, it's a great question. And I'd say I came into growth investing from a value background. So my first investing book was a Buffett book. It was Buffettology, which I now realize in hindsight was not a particularly well-written book, but it got me in the mindset of investing in high-quality companies, a long-term perspective, and paying a good price. Now, I'd already been into investing at that point and had an orientation towards quality, but nonetheless, so I kind of went down this like value path. But where I come into it from a growth perspective, I'd say is, and I guess how that evolved over time, I came to realize a few things. Like, I don't look down. Like, it's funny. A lot of growth investors look down on value, and a lot of value investors look down on growth. As Buffett's fond of saying, the joint at the hip. And ultimately, I think it's all about value investors and growth investors are looking for the best asymmetric situations at the position level and trying to put together portfolios that provide the best risk reward around that. And I think that's true across, whichever philosophy you're kind of embracing. With growth, what I'd say kind of appealed to me was there's a wider range of outcomes when you're investing in growth, for better and worse. But if your view is you can add value through analysis and active stock picking, then why wouldn't you skew towards the factor where there is a wider range of outcomes where qualitative analysis can add more value? So that was a big driver for me. And I guess I'd say too, that with growth versus value, if you're trying to factor them, I think it's a lot harder to factor businesses that are growing quickly and that aren't necessarily blueprints for what their business models are or what they've done. And not necessarily saying disruptors, but obviously disruptors count. But even businesses that are just relatively early in a nascent industry, it's hard to factor those kinds of situations. Whereas if you look at traditional value, to be blunt, you can get value beta really, really cheaply today. And if your game is large cap value, well, there are any number of ETFs you can go out and buy that, right? Now, obviously, this is podcast talking about microcaps, so you can't really factor that. And our small cap fund, we're really proud of that. And I'd say, that's a space where it's wildly inefficient. I'm really meandering from what your original question was there.
No, I like it. Keep going. Okay. Every direction. It's okay.
Fun. Cool. So now I'm just steering all over the road
Just
here.
Go. We're free for it. Podcast.
So to talk about Aussie Smalls in particular, what's unique about it is there may be another one out there, but it's the only pocket of the market I know of where Australian small cap fund managers on average outperform the benchmark net of fees. And that's, for anyone who follows markets closely, that's really rare and unusual. And I think a good question is why? Like, why is it there's this little pocket of 80 to 100 funds that collectively are able to outperform it? And I think it's a combination of things. I mean, one, generally speaking, when you're looking at smalls, you can find more differentiated, and microcaps in particular, you can find differentiated ideas and ones that aren't as well covered. And that's an extreme in Australia. So there are over 2,000 listed companies. The top 50 represent the bulk of the market cap of the index. On average, they've got something like 14 analysts on. When you get from the ASX 100 to 300, they have an average of 8 following them. And then you've got another essentially 1,600 companies that get virtually no institutional attention. And so if you're a small cap manager or a retail investor who is willing to just do a little bit of work, you can find a lot of interesting ideas before, I wouldn't even say big money, but smaller professional money can find it. And I'd say another thing with that is because we're so many, I'm assuming most people watching this are Americans. So many American investors, not just Americans, most people only invest in their home markets. And Australia is not tiny, but it's only 2% of the world's market cap. So there are some global small cap managers, but not a lot. And really, we don't get a lot of attention here from people outside of Australia. And I think it's partly home bias. It's partly we're on the other side of the planet, and it's really hard to set up a meeting with companies in Australia because time zones are so wacky. So, but for people who are willing to do the work and sniff around, there are great opportunities here, just like every other, market. But I would say Australia is a developed market that's, English speaking, very similar standards to the US, and I think would be pretty ripe for investors looking to do work from the US for international small cap and micro.
100%. And I would argue that, a lot of folks listening here, especially focused in microcaps, from those who I've talked to, a good amount of them, they'll go wherever, if they see a good opportunity, they make it work, or they figure out how to participate in whatever way they can. Right. And Australia is I love this country. I can't wait to visit one day, especially on the microcap side. It's such an active market down there. I've had Tony Hansen on here and Matt Joss from Maven, and they talked about that Australian mindset where it is somewhat of a gambling nation. They gamble on everything. That's not to say that investing is another casino or anything, maybe in some respects, but it's a little bit there, and
Australians gamble more per capita than any other country.
Yeah. So, it only makes sense that, there's such an active small micro nano cap community down there. Just maybe clarify for our audience. Does some of your funds have exposure to Australian names as well? Or do you specifically only look in US, Canada?
So I ran, I no longer do, but there are 2 Lakehouse funds. One's focused on global mid-large.
Okay.
The other is Australian, New Zealand, small and micro. So two different flavors of ice cream, but ultimately the same strategy underpinning them, just focused on different parts of global markets.
Do you look at all sectors, or do you tend to focus on any?
Well, we tend to focus based on business models.
Okay.
So we end up with heavy sector concentrations, but essentially, when we built out the team, I kind of approach it through the lens of, if our kind of first principles, if our goal is long-term outperformance, and we're going to do it through a high conviction, low turnover portfolio approach. Well, how do we do that? Well, we're probably going to be looking for businesses that can reinvest at attractive rates for a long time in growing markets with great leadership teams. And they probably have business models that underpin the ability to do that So instead of looking by sector or geography, why don't we have people focused on business models instead? So instead of having someone who covers Europe and tech, for example, we have someone who covers networks. We have another who does IP, and we have someone who does loyalty. And so we have 3 different internal research, I would say teams because they're not that big, but leads focused on deep expertise around those business models. And we'll go wherever they are in terms of sectors. We don't really pay attention to sector naming. We have a company, just for compliance reasons, I'll skip the name, but after we invested in it, someone on the team said, "Oh, hey, this is an industrials. So we finally own something in industrials." I'm like, "Oh, cool." But we've done all this work, but all purely qualitatively based, but it probably tells you a lot about how little we pay attention to.
Well, and the reason I asked that question is because Australia, in my conversations with folks, it's a very similar market in many respects with Canada, right? Where, especially in the small microcap space, where it's, majority junior mining, and then you have just this so overlooked small corridor of technology, healthcare, industrials that just gets completely overlooked because of it's both areas are so heavily dominated.
Yeah, that's a great point. And when you look professionally here, analysts tend to get trained on, because the indices are dominated by the big banks, handful of retailers, and mining. And so professionally, when analysts come into the field, that's what they focus on. There just aren't a lot of people in Australia who are very familiar with IT, with healthcare, with payments, e-commerce. And I know people who are, to be clear, so it's not like we're the only people here who know what an LTV to CAC is. But pound for pound, there are just fewer people here focused on that, even though there are plenty of great businesses listed.
So then, okay. We more or less, I think, could figure out what sectors then you do focus in on. So, I mean, how do you protect against downside risk then when you're looking at some of these, looking at tech,
sure,
cyclical?
So at the position level, what I'd say is that, and what I said, before, coming from a value perspective, I guess the reason I mentioned that is your value investors tend to think a little more first around capital preservation and then upside. But even though I'd say I'm a growth investor today, and if you take what we own and shove it in a Morningstar style box, it's like your growth. We still have a legacy of, look, we want upside. We're about upside capture, but we can afford to be a little bit choosy and still try to contain our downside as well. And I think a lot of growth investors have this habit sometimes of viewing investments as almost like lottery tickets. And I'm like, yeah, look, again, we want the upside, but let's try to control for our downside. So for us, the first layer of that is we're heavy checklisters. So we've got a 27-point checklist we work through with every position. There's a range of upside factors, downside, I should say traits, not factors, but that we're looking for in qualities and companies. And some of those are positive, some of them are negative. And those items are based on our experience and empirical evidence wherever possible. Everything we look at goes through one of those checklists, and it just really helps us to assess pretty quickly. All right, do we think, generally speaking, this might have the kind of skew we're looking for? If yes, then that proceeds to doing a full piece of work, and that'll be led by one of our analysts who's a lead on the core business model that business is in. And to that point, we don't look at anything unless it has a business driven by really strong IP, very loyal customers, or network effects. So already you've kind of taken this like big universe and, taken it down to here.
Let me ask you about this. I mean, because in my experience, also in talking with, Australian listed or Australian based, New Zealand based, the ones that tend to be a little more interesting are ones that aren't just focused specifically on selling to the Australian market or to the New Zealand market, staying within their borders, which, hey, that's not to say you can't build a huge business. And I mean, there's millions of people that live in Australia, millions, that's not to say anything, but like, when you have a company that's thinking a little bit more globally, it makes it a bit more palatable.
Yeah. Oh, absolutely. And if you look at the biggest winners, it is hard to build a software business in Australia that could be worth $1 billion if you're only focused on Australia. There are exceptions, like Iris. We don't own it at the fund, but they are the dominant order management system for brokers and buy side here in Australia. They have over 90% market share. It's just this intense network effect where if you do domestic trading, you're a domestic fund manager, you use Iris. It's almost impossible to not use. And they charge like how you would think they would charge. But outside of that, that's an extremely niche thing. For the most part, the path that you'll see is someone develops a really cool product or piece of IP, piece of software here, and they're able to export it successfully. And they can do that because the product itself adds a lot of value for customers and has inherent dynamics that are somewhat viral to them. And when that happens, it can work out in a big way. I think if you look at Atlassian, that's the flagship, titan of Australian tech, which sadly is not listed on the ASX. But yeah, even at the smaller end of town, we've had some big successes with Australian-based companies. CEO can be here, CFO is based here, but they'll have 80% of their revenue from overseas and heavily from the US, which probably won't surprise anyone.
So on that note, I mean, like how early have you gotten in on some of the, as you said, you're on the growth side, but have you ever looked at or owned a few of these tech names where they didn't hit that inflection point just yet, but you could tell based on their IP and their tech having looked through, you're like, okay, there is potential mass adoption globally, but they're just not there yet. But we want to maybe look at it right now.
Yeah. Yes, fortunately, and also unfortunately, where I've missed those two. But I'd say where you, I guess like the educational side of this, where you tend to find those is situations where you've got great domestic product market fit, where you're working with partners who want to take your product overseas. So if we were to use Afterpay as an example, I don't own it personally. We don't own funds. I should say we don't own Atlassian either. I don't own it personally. But we used to own both of them at the funds. Afterpay is one where started in Australia. Where did they move next? They didn't kick the door down and go straight to the US. They moved to New Zealand, which is like Australia's little brother. No offense to the Kiwis, but it's about 4 million people. It's a great test market for iterating outside of your home country. The thing is that was really promising. They had retail partners who wanted to bring Afterpay to other countries. And they're like, look, we're really happy with what this is doing here. We'd love to take this to the US, UK, New Zealand. And so they very carefully started with New Zealand. And then when they went to the US, they even got someone to help fund that. They had a local VC who invested a lot of capital specifically into the US division. So it was kind of a heads, we win and keep 80%, tails, we lose your money situation, which we found attractive. And because they built up great relationships with retailers here who happened to be US based but had Australian operations, they had a running start into the US. They'd already proven product market fit and they could distribute here. There weren't any quirky language barriers or business model reasons why we couldn't see it working in the US. And so that would be the ultimate example of one where we probably caught the S curve at the best moment. And I could say there are ones where, but for every one of those, most businesses that do try to go overseas fail, right? Yeah. And that's not, Australians, I find, can be a little hard on themselves. They're like, oh, most of the time it doesn't work. I'm like, well, that's true, but that's the base rate for every country, because it is hard to take your business and go overseas. But, when it works, especially when you're scaling into a market that's 13 times the size of the one you're in, that's a pretty attractive range of outcomes when it works.
That's pretty awesome. Was there ever a time that you thought was such a sure thing and were so wrong? You're like, oh man, like that hit all the boxes. Like, oh, dang it.
Oh, sure. I mean, I don't know if I'd say sure thing, but we've definitely had like one of our bigger positions at the small cap fund, a company called BWX, which we don't own anymore. They have a brand called Sukin. It's Sukin. Very popular here in Australia. It's like a natural cosmetics brand and skincare brand. Gained a lot of share really quickly. Seemed to have potential moving overseas. They had some good distribution partners that had us excited for a variety of reasons. That thesis didn't work out like we wanted. But I would say, the US and UK expansions just didn't go quite like we thought. In the UK, they had good distributing. Well, they had shelf space, but you didn't get the sales flow through that we were hoping for. In the US, they made a couple of acquisitions to help bolster that, which did not work out well. So it happens. But I will say, for the ones where it really works, when you're moving into such larger markets, it really, really works.
Joe, I gotta ask, man, like, after you moved to Austin, I mean, you haven't made clear exactly what you're going to do yet, but we would all assume you're still going to be an investor in some shape or form. But like, are you still going to look at Australia, or are you now going to maybe shift more of your focus back in North America, US, Canada?
Nothing really to speak, nothing to announce today.
No, I didn't mean to lie. I don't, yeah.
But look, I mean, I'm not retiring, but I will say that, the experience I've had here, I've loved. And, the world's a big place. There are a lot of great small companies out there. And, the experience I've had here it's not invaluable, but it was valuable. And, I'll definitely keep looking. I think it's fair to say, when we move back to the States, I will not be a US only investor.
There you go. Okay. Hey, another thing when it comes to Australia, and I've asked this to Tony, I asked this to Matt, I asked this to a few people when we talk about Australian investing, especially in microcaps. How do you deal with these share structures? I mean, billions of shares outstanding, to anybody who's listening that loves, tight share structure, high insider ownership, that's one thing that's still so hard to get your head around.
And I guess what Bobby, this is what directly he said, but something that's quirky about Australia is the share prices of companies are what you would consider to be penny stocks in the States. So, we've had, top of head, most of the positions we had at the small cap fund, when we initiated, had single digit share prices and oftentimes below $1. Our biggest win was a business where it was around $2 a share when we invested. So, just culturally, the way bankers and companies try to frame the pricing of their stocks is different than it is in the States, where that is viewed as a negative. Here, it's viewed a little more as, hey, you're early, you get more shares for the same amount of money. And that's kind of the way it's framed. Obviously, it doesn't matter, how many slices the pizza is in, or the same size pizza. Yeah, I guess it's something to get used to. But to your point, and I think to get back to something else from a micro perspective, there are a lot of companies here that are listed where you do have really tight registers that, if you're managing a few $100 million, that's a challenge. If you are an individual investor or you're running a small fund, frankly, it's not a deal breaker. Like, one of our biggest wins here was a business where the founders owned 2/3 of the company. And even though, like, if you looked at the business, you'd be like, it's a dream. So we still own it. So I won't get into what it is, but strong, back when we initiated, strong net cash position, founder led, great margins, growing quickly because the company had hugely captive and loyal customers, big market opportunity. They had small market share, but were gaining rapidly against really checked out competitors globally. They had just won some major customers who were proof points for winning more business. And I think at the time it might have had one analyst professionally who was putting out estimates and a rating on the stock. Might have been two, but virtually had no coverage. And the reason was just liquidity. And I think something that I think a lot of your viewers / listeners will be familiar with, but a lot of people who don't necessarily play in the space may not realize is there's this vicious cycle, or virtuous, depending on where you are in it, where brokers and analysts at the same house. They don't want to cover companies where there's no liquidity because their clients, being fund managers, don't want to invest in companies where there's no liquidity. So they just don't get attention. And in turn, there's a feedback loop here where the fund managers don't see these companies because the brokers aren't putting them on the radar because they're not being covered. So it just kind of feeds on itself over and over. But, when you look around, you can find companies like that. I would say with that company too, it's screened beautifully. Like if you were just running really basic screens, you would have seen it. It was just hiding in plain sight. But because of the liquidity, the pros just really ignored it.
Not to go on a different tangent or anything, because I have another follow-up to that, but and this is going back to your background. And the more I think about, what brought you to Australia to begin with, and in reflecting and speaking with you on some of the other conversations I had with other investors in Australia, and this kind of the Australian investing microcap culture. I mean, what was it like opening the Fool down there? That has this never sell long-term approach.
It was really well received, to be honest. I think that most people are not long-term investors, but the ones who are, when you speak their language, it resonates with them. And I think generally people just find it refreshing because it's intuitive. So we're going to invest in really high quality companies and hold on for a long time and not trade a lot. That's pretty intuitive. You don't need to. Most people on the street, if you explain that to them, they're like, yeah, they do a lot of nodding. They get it. It's not overly complicated. So,
research process. Joe, can you tell us a little bit about that? Once you find a company, what are some of your channel checks so that you're like, okay, we're going to start to size into this position?
Sure. So, as I mentioned before, first step is anything that's brought to the table has a business model that we're already behind. So that's IP, networks, loyalty. We get literally to the table, although this is back when we actually met around the table. Now it's over Zoom, but something like 2/3 of the ideas that analysts bring to the table to talk about doing a checklist on, we decide we're going to proceed with, but a third we leave on the cutting room floor. So of those that get to that, the analyst will go off and do a 27-point checklist, positive and negative traits. That's then peer reviewed by everybody on the team. And we provide feedback notes. We get together and discuss it. From there, we make a decision as a group, typically led by the PM. But if the analyst is excited on progressing to a full piece of work, and for context, probably half the companies that we do a checklist on progress. That ratio has fallen over time as we've gotten, basically as we've worked through more companies. It's just getting harder and harder to get something in when your turnover is so low. From there, then you do the full piece of work. And this is probably the meatier part that I think a lot of analysts find sexier. But I will say, before I get to that, I do think checklisting, there's a lot of virtue in it because it provides consistency, rigor. And sometimes the things in it can seem boring and mundane, but they can be easy to check and helpful. So I'll give you an example. We had a company once that I was looking at. My sniff test of it was really interesting. But I was like, well, we're not going to short circuit the process here. I'm going to go through and do the full piece of work here. And then going through the checklist, I got to reputable auditor, which normally is a pretty quick yes or no. And I'm guessing, plenty of people would say that a Big Four auditor doesn't necessarily mean that everything is great with the books. But particularly with smalls and micros, you do need to pay more attention to who your auditors are. So I was like, all right, I'll check the auditor, and I go and check, and I'm like, I haven't heard of these guys actually. And when I went and looked, they only did the books for 8 companies, one of which I knew from a friend had shady books, like very shady. And that allowed us to avoid what on a sniff test was interesting, turned out to do really badly, and allowed us to avoid that. And again, it was one of those things where we've done hundreds of checklists. That's probably one of a handful of times where we had serious concerns about an auditor, but it allowed us to avoid, a big mistake, assuming we would have invested. It takes 2 minutes to check that, right? But a lot of people don't. So just having just a systematic framework for, okay, check this, that, this, using that to help shape and make sure you're consistent. So then getting to the more fun qualitative part. I think ultimately, again, what we're trying to find here is a deep understanding of the business model, the economic model, how money flows in and out of the business, returns on capital, not at the group level, but at the unit level, and really trying to unpack unit economics, understand product market fit. And at the end of the day, what we're trying to understand, what are the ways things can work out? So I think a lot of investors focus, and we do focus on what can go wrong, and trying to eliminate potential points of failure in a thesis, like, is there an issue with an auditor, for example? But at the end of the day, equity investing is about upside. And so we're trying to find ways that we think credibly that we think something can work out. Then there's the layer of what is our variant perception around that? So what do we see differently about this business and its economics and its leadership and its market that the market doesn't already see? This probably isn't a revelation to anyone, but business might be growing quickly. Everyone agrees. That doesn't necessarily mean you have variant perception, right? But I found if you don't have clear variant perceptions on a business, either you don't know it well, or the market's already priced it really well, right? So, identifying those and really articulating them clearly is a really, you could say that's the heart of the qualitative side. And that's driven by a deep dive into, again, like unit economics, management. So what is their background? What are their incentives? What's integrity? And a lot of that is squishy and hard to define. But sometimes you get that from company meetings on incentives. A lot of that's just plainly available. You see how people are motivated. Lo and behold, if a CEO is incentivized to grow revenue, or let's say EBITDA, but there's no per share item anywhere involved and no returns on capital involved, they're going to make an acquisition. They're going to. And it never fails. And as we know, most acquisitions destroy value. So there are exceptions, but you can get some simple insights into just looking into this, specifics on how people are compensated. I'm really trying to unpack all that, try to understand. Obviously we look at financials, but I'd say we're less concerned about today's P&L and more about what are the unit economics of this business. What is the opportunity we see ahead? How do we think they can scale what they have today? And I think it's treated us well, but that's how we tend to approach, viewing our companies. And then in terms of thinking about risk, I'd say we've already started that in the process with the checklisting. We go deeper into that, and then we try to explore in more detail around particularly things like competitive dynamics. So one of the things we'll do is a 360 review around, what's engagement like, what's competitive landscape like, how do these guys engage with shareholders, suppliers, regulators. But with risk, it's just understanding all the more big, hairy, complex pieces of it. And again, if you can't articulate what those are and you don't know what the bear case is well, then you probably don't know the business all that well. So we'll try to work through all that. And then at the end of it, let's say something's worked through, we've decided independently, we think this is an opportunity that's going to beat the market. Then it's a question of, well, how do we size this, to get back to the tail end of your question? And we'll look at that in terms of how does this position need to be funded? And so something that I do, even though I was the PM, I would always have our analysts try to propose how they would fund the position and how they'd size it, because I want our analysts thinking like PMs, not just thinking like investors, not analysts who write book reports, but active investors. And, in terms of that, we'll think about, okay, well, what does this bring to the portfolio in terms of potential return? What's our confidence around that return? How does this move in correlation with other positions we own, both in terms of like day to day? How does it move in terms of factor risk? but also from a business model standpoint, a longer term view. What exposure does this have that other positions in the portfolio have as well that may not show up in a factor analysis, but we know are underpinning risks or opportunities to the business? There's a lot of art to that, and there's a lot of math and science that informs the art, but from there, we'll ultimately make a decision and size it. And most of our positions, average size, probably 4 to 5%. We typically initiate with 2% minimum chips. Anything smaller than that, and we're kind of like, what are we doing with this? It's not worth the time and focus and clients' capital. So.
And Joe, real quick, how much time do we have left?
Well, I just saw outside that our kids got home and they're boisterous. So.
Okay, I'll get to we'll get closing it out. So then, Joe, you've mentioned a number of investing experiences already that have kind of influenced your thought process and different theses. But what would you say is that one investing experience that changed your career or just really made you think a certain way about investing the most?
Oh, that's a great one. Can I get two? Do two?
No, no, not two.
No, shut down.
Not two. Okay. 4. No, I'm just kidding. No,
sure.
give 2. Come on.
One would be when I went to the Value Investing Congress in New York back in, call it 2010, might have been 2011, but thereabouts. And there was a presenter from India who came up, and he was like, I'm going to tell you all about a company we're invested in that is of comparable quality to many other ones I've seen today, but it sells for half the price. And the reason is that all you guys are all competing with one another in this very large, efficient market. You all went to the same schools. You're all very well trained. You've all got Bloomberg terminals. But where I'm looking, I've got a lot less competition. So with that, and it really just socked me in the stomach. And I was like, I'm only looking at the US market. I never look outside of this country, even though most, roughly half the world's market value is outside of it. And I know that that's less efficient than what I'm looking at. And that was a real eye opener for me. And ultimately was this, not the only spark, but I'll say it poured gasoline on, man, I need to get outside the US and look around and see what's out there. So that was one. Another was a comment that David Gardner made one time. And this is a little on the fly, but something effective. Someone asked him one time about how they locked in a gain of 25% on something. And he's like, look, that's great. But to be honest with you, it's hard to make big money in markets locking in 25% gains. And I was like, yes, it's such a basic statement, but ultimately his point is you need to let winners run, and without letting, particularly for high growth companies, if you're not letting those run, you're not capturing that upside tail, then essentially you're just you're locking in a bunch of 25% wins, and then maybe half the time, let's call it half the time, and the other half you're probably realizing a loss. And so it's just it's a simple sounding thing, but it resonated with me. So
I like it, and I agree. So, as we're rounding the bend here, my final question to you then is, for those who listening in maybe are a little green, or a little newer to markets or even microcaps, what advice would you have for them?
Well, I think with particularly, so high level one, while I've talked about the virtue of being a high conviction investor, again, that's in the context of owning, 10 to 20 companies. I think a lot of retail investors, new investors make a mistake of they own a couple of stocks, and that's just way more concentrated than most people can handle. And the cold truth is when you're brand new to investing, that's all the more reason to not be super concentrated. Like when you've been doing it for 20 years, you have a much better feel and knowledge around what risk looks like, even at the position level, and what a great opportunity can look like. When you're brand new, that's terrible risk management. So, diversifying, not just across holdings, but risk profiles, business models. Another would be actually know what you own. I can't tell you how many individual investors I've met who bought something off it. They just saw a tip on a message board, so they bought it, or they heard about it at a barbecue. They know the ticker. They may not even know the name of the company. And it's a little like, you seriously would have been better off just going to Vegas and putting money down, because at least you would have had fun losing your money. So, just take the time to understand what it is you're investing in. I guess a third thing would be write things down. And so that's a big part of it. Like, we're very thorough, again, like not just checklisting, but anytime we make a change to a position size, to a target allocation, we write it down and we just say, look, this is why we're doing it. Here's how we're thinking about the return and risk and how this position fits. And it can seem like a chore when you're doing it, but it provides a lot of discipline, because before you go and invest, you're actually writing something down and saying, this is why I'm doing it. Or, this is why I'm making a change. And it just provides a bit of an emotional handbrake to what you're doing. And I think you just start a simple Google Drive file or Word doc where you keep up with that. It could do a lot for your investing psychology.
All right. Well, with that, Joe, where can our audience go and find more information to follow you and all your next moves?
All my Austin barbecue recommendations.
Yes.
On Twitter is probably the best place. It's just @Magyer, or spelled Magyar. But I'm on there and active, and DMs are open. If you happen to be in the Austin area, we'd love to connect. So get in touch.
Very cool. All right. Well, at some point, we'll be at Terry Black's, I'm sure, very, very shortly. So,
cool.
Joe, really a pleasure. Thank you so much for joining me today. I really do appreciate it. Good luck. Really good luck on the move. That's a pain in the ass. I wish you all the best on that. And stay safe. And I look forward to speaking to you again soon, either virtually or in person.
Great. Thanks, Bob.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.